Hey everyone, and welcome back to Ground Zero. First off, I just want to say I've been blown away by the response to the first video. Seeing so many of you excited to learn and take action is exactly why I'm here. And I've said it before and I'll say it again. The fact that you're here putting in the work already sets you apart from most people out there. Keep showing up for yourself, and this journey is just getting started. Now, let's get into today's topic, technical analysis. I'll tell you right now, this is where trading gets really exciting. If video one was about understanding the why behind the market, today we're diving into the how. How do we make sense of all those numbers, charts, and trends? How do we spot opportunities before anything else? That's where technical analysis comes in. And let me tell you, mastering this will change the way you see the market forever. Let me start with a quick story. When I first got into trading, I was just like most beginners, starting at charts and staring at them, completely overwhelmed. Now, it looked like another language with, all these lines, candles, and random movements. And I remember thinking, how do people actually make decisions with this? But as I started learning technical analysis, it was like the market started speaking to me. I began to see the patterns, trends, and logic in what seemed to be chaos before. And that's exactly what I want for you, to look at a chart and feel in control, not confused. So what is technical analysis exactly? Well, in simple terms, it's the study of price movements. So we're looking at historical data, things like charts, patterns, and trends to predict what might happen next. So think of it like learning to read the market's mood. Every price movement, every candlestick tells you a story about what buyers and sellers are doing. Now, your job is to understand that story and use it to make smart decisions. The beauty of tech analysis is that it's not based on data and not emotions. So you're not relying on hunch or a gut feeling, but rather working hard with facts like price, volume, and trends. And here's the best part, the tools and principles we're about to learn can be used across all types of trading. Whether you're into stocks, options, or futures, they're universal. Now, before we dive into the details, I want to make one thing clear. Tech analysis is not magic. It's not going to guarantee you a win every time, and anyone who tells you otherwise is selling you a fucking dream. But what it does give you is an edge. It gives you a way to approach the market with strategy and confidence instead of just guessing. So let's keep it simple for now and focus on three core concepts. Number one is trends, which is understanding the direction of the market. Number two is going to be support and resistance, which is identifying key price levels where market reacts. Okay, and number three is tools that help you confirm what you're seeing in the charts, which is our indicators. So these three building blocks are the foundation of tech analysis. Master these and you're going to have a solid framework to start analyzing the market like a pro. All right, that's where we're headed. Stick with me because in the next section, we're going to dive straight into trends and how to spot them and how to follow them, and most importantly, how to use them to your advantage. All right, let's get straight into it. Trends. So if you've ever heard the phrase, the trend is your friend, then you know exactly how important this concept is in trading. Trends are like the heartbeat of the market. They tell us whether the prices are moving up, down, or staying relatively flat. And if you can spot a trend early, you can ride that wave to some serious opportunities. Now, here's the thing about trends. They're not just random. They are driven by the collective decisions of millions of buyers and sellers. When more people are buying than selling, prices move up. And that's an uptrend. When more people are selling than buying, prices move down, and that's a downtrend. And when prices are moving sideways, bouncing between certain levels, that's what we call consolidation. Okay, so let's break these down. Number one is uptrends. An uptrend is exactly what it sounds like. Prices are consistently moving higher over time. Picture a staircase. Each step up represents a higher high, and each dip along the way represents a higher low. Now, these higher highs and higher lows are what define an uptrend. It's like the market is telling you buyers are in control. Here's where it gets practical. When you're trading in an uptrend, the goal is simple. Look for opportunities to buy on the dips, those moments when the price pulls back slightly before continuing higher. Now, this is where patience comes in. You're not chasing the market, you're waiting for it to come to you. So next is downtrends. A downtrend is the opposite. Prices are consistently moving lower over time instead of higher. Higher highs and lows, right? So highs and higher lows if you're looking at lower highs and lower lows. This is the market's way of saying sellers are in control. In a downtrend, the strategy flips. Instead of buying the dips, you're looking for opportunities to sell on the rallies, those brief moments when the price bounces up before continuing lower. It's all about aligning yourself with the overall direction of the market. Next up is consolidation or sideways markets. Now, not every market is trending all the time. Sometimes prices move sideways, just bouncing between a clear high and a clear low, and this is called consolidation or a range-bound market. Think of it like a tug of war between buyers and sellers, where neither side is really winning. Here's what's cool about consolidation. It often acts as a setup for the next big move. So once the price breaks out of that range, whether it's upside or downside, it can signal the start of a new trend. And as a trader, being able to recognize these moments can give you a huge edge. So let me share just a quick little example of mine. When I first started trading, I was so focused on trying to predict every single move that I ignored the bigger picture. I'd see a small price dip in an uptrend and panic, thinking the market was reversing. But over time, I learned to zoom out, and you will as well, and you'll learn to trust the trend and to focus on the overall direction. That simple shift in mindset made a massive difference in my results, and you're going to see exactly what I'm talking about as we continue. Now, how do we spot these trends? Well, start by looking at a candlestick. You start looking at the candlestick chart and paying attention to the overall direction of the price. Is it moving up, down, or sideways? If you're not sure, here's a pro tip. Use a moving average. A moving average is a line that smooths out price data over a specific period, making trends easier to spot. For example, a short-term moving average, like the 9-day or 29-day, helps you see the immediate trends. A longer-term moving average, like the 50-day or 200-day, gives you a bigger picture of where the market is headed. So when the prices are consistently above the moving average, it's a sign of an uptrend. When it's below, you're likely in a downtrend. Pretty simple, right? So trends are the foundation of technical analysis. By understanding the market's direction, you're already setting yourself up for a smarter, more confident trading decision. In the next part, we're going to build on this by diving into support and resistance, two key concepts that help you pinpoint exactly where to enter and exit your trades. Stick with me. This is where things really start to come together. All right, now that we've covered trends and how to identify them, let's take it a little bit further. We're going to talk about two of the most powerful concepts in trading, support and resistance. These are like the road signs of the market, telling you where prices are likely to pause, reverse, or break out. Mastering these concepts will help you make better decisions about where to enter and exit your trades. So what is support? Well, support is a price level where a stock tends to stop falling and bounce back up. Think of it like a floor, a point where buyers step in and say, this is too cheap to ignore. When the price reaches this level, the demand increases and the selling pressure decreases. So here's an example. Imagine you're trading a stock and every time it drops to 50, it bounces back up. That $50 level is the support because that's where buyers are consistently stepping in and buying more. So the more times the price bounces off that level, the stronger the support level becomes. But here's the twist. Support isn't guaranteed to hold forever. If the price breaks below the support level, it can signal that sellers have taken control and the price might drop further. This is where breakouts come into play, which we'll talk about in a minute. But what is resistance? Well, now resistance is the opposite of support. It's a price level where a stock tends to stop rising and pull back down. Think of it like a ceiling, a point where sellers step in and say this is too expensive to keep buying. When the price hits this level, the selling pressure increases and the buying pressure decreases. Let's go back to our example. Imagine the same stock rises to $60, but every time it hits that level, it starts to fall back down. That $60 level is the resistance because sellers are consistently stepping in at that point. Just like support, the more times the price bounces off that level, the stronger the resistance becomes. And just like support, resistance can also be broken. If the price moves above the resistance level, it can signal that buyers have taken control and the stock might continue to rise. So the power of support and resistance. Here's why the resistance and support are so important. They're not just random lines on a chart. They're psychological levels where buyers and sellers are making decisions. These levels represent real human behavior. They're points where traders are willing to buy, sell, or hesitate. When you can identify these levels, you gain a massive edge. You're no longer guessing where to enter or exit a trade. You're making decisions based on clear, observable patterns. So how do you use support and resistance to your advantage? Well, here's two practical strategies that I personally would recommend. Number one is trading bounces when the price approaches a support level. You can look for buying opportunities, expecting the price to bounce back up. Similarly, when the price approaches a resistance level, you can look for selling opportunities, expecting the price to pull back down. Now, this is a simple but effective way to trade within a range. Number two that I would recommend is trading the breakouts. Sometimes the price will break through a support or resistance level. When that happens, it often leads to a big move in the direction for the breakout. For example, if the price breaks above a resistance level, it's a sign that buyers are in control and the price might continue to rise. Breakouts can be a great way to catch strong momentum trades. I remember one of my first big trades when I was watching a stock that kept bouncing between $100 and $110. At first, I just sat and I watched the price move up and down, not knowing what to do. But then I realized I could use those levels to my advantage. And you have to keep in mind, we can take these small moves. We don't need huge moves in the stock. $10 is pretty significant. So I started buying near the $100 mark and selling near the $110 mark. And for a while, it felt like I was printing money. I mean, literally, you would buy at the bottom, it would go up, and you're making huge percent on that just because it's it's a same-day expiration trade, for example. So eventually the stock broke above $110 and I called the breakout for an even bigger move. That's when I really started to understand how powerful support and resistance can be. Support and resistance are the foundation of smart trading decisions. When you learn to spot these levels, you're not just reacting to the market, you're anticipating its moves. In the next section, we're going to build on this by introducing technical indicators, which are tools that help you confirm what you're seeing in the charts and give you even more confidence in your trades. So let's keep this momentum going. All right, now that you've got a handle on support and resistance, let's take things a step further. In this part, we're going to introduce technical indicators, which are powerful tools that are going to help you confirm what you're seeing in the charts. Now, think of these as your trading assistants, which give you extra clarity and confidence before making a move. Now, here's the thing. Indicators are not magic. They're not going to make decisions for you, and they're definitely not foolproof. But when you use them alongside the fundamentals that we've already covered, which are trends, support, and resistance, they can become a very valuable tool in your trading toolkit. So what are technical indicators? Well, in simple terms, technical indicators are mathematical calculations based on price, volume, or both. They help you interpret market conditions and spot potential opportunities. There are hundreds of indicators out there, but as a beginner, it's important not to get overwhelmed, just like with anything in trading, and instead focus on a few key ones that are practical, easy, and simple to understand. And most importantly, they're widely used by traders. So let's break down 3 of the most useful indicators for beginners and what I personally started with. So number 1 has to be moving averages. We touched on this earlier, but let's dive a little deeper. A moving average smooths out price data to help you see the overall trend more clearly. There are 2 main types. Number 1 is simple moving average, which is the SMA. This takes the average closing price over a specific time period, like 20 days or 50 days. And the second one is exponential moving average, which is the EMA. Now, this gives more weight to recent prices, making it more responsive to recent market activity. Here's how you use them. When the price is above the moving average, it's often a sign of an uptrend. When the price is below, that's usually a sign of a downtrend. One simple strategy is to use 2 moving averages. So a short-term one, like a 9-day, and a longer-term one, like a 21-day. When the short-term moving averages cross above the longer-term one, it's called a bullish crossover, and it can signal a potential buy opportunity. The opposite, which is a bearish crossover, can signal a potential sell opportunity. If you need, replay this and listen carefully and really try to compartmentalize this. Number 2 is relative strength index, which is our RSI, and the RSI is a momentum indicator that measures how overbought or oversold a stock is, and it's displayed as a number between 0 and 100. If the RSI is above 70, the stock is considered overbought, which could mean it's due for a pullback. If the RSI is below 30, the stock is considered oversold, which could mean it's due for a bounce. Here's an example. Imagine you're watching a stock in an uptrend, but the RSI is creeping above 70. This could be a signal to hold off on buying because the price might pull back soon. On the flip side, if the RSI is below 30 in a downtrend, it might be a good time to start looking for a reversal. Number 3 is our volume indicator, which might not seem like an indicator, but it's one of the most important tools you can use. It tells you how many shares are being traded in a given period and can give you insight into the strength of a price move. So for example, if a breakout above resistance happens on high volume, it's more likely to be a strong sustainable move. But if the breakout happens on low volume, it might be a false signal and the price could fall back. Watching volume can also help you spot momentum. If you see a big price move accompanied by a spike in volume, it's often a sign that the move has strong support from traders. Combining indicators is crucial because here's where the magic happens. Combining these indicators with trends and support resistance to create a complete picture is one of the most important things you can do as a trader. So let's say you're looking at a stock. The price is in an uptrend and bouncing off a support level. The RSI is in a healthy range, not overbought or oversold. The breakout above resistance happens on high volume. This combination of signals gives you a much higher probability of success compared to relying on just one factor. And that's key. Indicators aren't meant to be used in isolation. They're tools. They help you confirm what you're already seeing. Back in the day, I used to rely on just one indicator, and I thought that it would give me all the answers. So I'd see how, the RSI drops below 30. I'd jump in only to watch the price keep falling. And it wasn't until I started combining indicators like RSI with support and volume that things started to click. And suddenly my trades became more calculated and my confidence went through the roof. And listen, it's all about using the right tools at the right time. Alright guys, that wraps up our introduction to technical indicators, and you now have 3 really powerful tools. You have moving averages, RSI, and volume to help you confirm trends and spot opportunities in the market, as well as avoid false signals. But remember, these are just tools. The real magic happens when you combine them with the concepts we've already covered, our trends, support, and resistance. And just keep in mind, you're building a foundation here that most traders skip. And that's going to set you apart. Keep practicing, keep learning, and most importantly, keep showing up. In the next video, we're taking everything we've learned so far and putting it into action by building your very first trading strategy. So I'll see you there.